All right, so let's begin. What do accountants do? Does anybody know?
Talking about the money where it's going, where it's coming out.
Okay, they track money, they track income, expenses, cash. Reconcile. Are you here to do an evaluation?
Is this your first class?
It is. It's a little early for the evaluation. 5:20? No, that only goes for 5 weeks.
Oh.
That ended after 5 weeks.
So, great. Thank you.
You missed your window on that.
Okay.
I thought we were off to a good start. She could have done it. Sorry, you were saying? Yeah.
I just said
Reconcile, that's right. They do that.
Prepare statements.
They prepare statements. Well, accounting is a lot of things to a lot of different people. It's the audit function, it's the corporate finance function, it's the tax function, it's a consulting function, it's a regulatory function. The FBI, Homeland Security, the two biggest professions they draw from are lawyers and CPAs. Generally, we're going to think about two types of accounting. Can you read that okay? I mean, not in the room. If you can't see it, let me know. Managerial accounting is people that work for corporations, corporate finance, manufacturers. And their goal is to collect information and provide feedback so the operation operates more efficiently, more effectively, produces more profit. Managerial accounting doesn't have any rules. It's the only users of the information are the people producing it. It's like when you're a little kid, if you have a friend, you can make up your own language as long as you're the only two that needs to understand it. Financial accounting, the sole purpose is to communicate information to outsiders, stockholders, lenders, regulators. So because of that, financial accounting has a substantial set of rules. The reason we could communicate is because we have a common language. The reason we know what time it is we've agreed on a certain set of parameters for time. If we didn't have those agreements, it'd be very difficult to communicate, to show up on time. So we have these rules in place, so when we prepare information under these set of rules, the people who get the information know the same rules and can interpret what was prepared. The rules are prepared by a group called the FASB, Financial Accounting Standards Board, and the rules are collectively known as GAAP, Generally Accepted Accounting Principles.
Can you say it again? General what?
Generally Accepted Accounting Principles. Internationally, there's a different set of rules called IFRS, International Financial Reporting Standards. And we usually call this GAAP and the IFRS we call IFRS. In the US, you can choose to prepare your financial statements under IFRS. Though I'd say most people prefer GAAP. The structure of a business can take many forms. You have the sole proprietorship, business owned by one person. You have the partnership, business owned by two or more people. You have the corporation, which is considered a separate legal entity from its owners. And in fact, in legal documents, a corporation is referred to as a person. Then you have this last group, which is relatively new, the LLCs, LLPs. LL stands for limited liability. C stands for corporation. P stands for partnership. Each of these entities has advantages, has costs, has disadvantages. Has anybody ever formed a business?
Yeah, I have.
What kind of business?
A wholesaler.
And what form of ownership did you choose?
Post common actually in Saudi Arabia was established. Just owned by solo.
Sole proprietorship. Okay. Anybody else?
Yes.
LLC.
You did the LLC. Why did you choose the LLC?
The
Flexibility.
financial advisor actually said that it's better for me to use the LLC. Obviously, if you have a sole proprietorship, they can sue you for you,
Right.
and your worth, as opposed to being semi-protected with an LLC.
Okay, so that's one of the reasons why you would choose an LLC or a corporation. It's called limited liability. And the value of that can't be overstressed.
Right. And the LLC, as opposed to the corporation, because I want it to be 100% owner. I don't want anyone else.
Corporation could have one owner.
Yeah, I'm a corporation one owner.
You get to choose how you want to be taxed.
Corporation, you can be one owner.
Corporation could be one owner.
So why it's named corporation?
What makes it a corporation?
Yeah, why did it name corporation if it's one owner?
Because the corporation exists as a separate legal entity incorporated in a state under the auspices of the Secretary of State. The number of owners is determined by who owns the shares. And if it so happens that only one person owns the shares, it just has one owner. Now, limited liability is a very important concept. That really separates tax consequences aside, which for some of these you can handle separately. Limited liability is the number one reason people incorporate. I had businesses, most of the time I've incorporated. One time I had laundromats. I used to own laundromats. And one of them I owned was in a little town called Kingston, New York. I don't know if you guys ever heard of that. The laundromat was a dump. I'll tell you, if you ever think of an ugly, old, rundown laundromat, this was it. Now, I've owned some beautiful ones, but this one wasn't one of those. And we had a back folding room. And in the folding room, there was a door that we had on a chain, so if it was a hot day, we could open the door and hook the S-hook into an eyelet, and it would stay open. But this was during the winter, so the door was closed. And a lady and her daughter must have been about 6, was back there folding. And we had a little, about a foot-high piece that ran along the window. And the girl was having a great time. She was standing on it and jumping off. Jumping in. It's great. She was having a ball. Then she said, I imagine she thought, what would make this better? She said, why don't I jump off and put the S-hook at the end of the chain in my mouth? So I don't know if you've ever seen the cartoon where they tie the axle of the car to a tree and the car goes, and when the thing is straight, it just pulls it right out. That thing went right through her face. Some of my stories have punchlines, but this is not one of them. So limited liability meant I didn't have to worry about losing my properties, my investments, my businesses. What was at risk was the corporation that owned the laundromat. And what the corporation owned was the washers, dryers, and pieces of equipment like that. The building I owned separately in a separate corporation, which I guess you could sue that as the owner of the building. But outside of that physical corporation, and everything else is protected. If I was a sole proprietorship or a partnership, everything I owned in life could have been at risk. Now, fortunately, it never came to a lawsuit. I didn't get sued. The insurance was very good. It made the family, I guess, feel like they were taken care of, that they didn't need a lawyer to sue. But in the end, you can't always count on that. So as much as I felt bad for them, I didn't have to worry about what was going to happen to my assets. And that's the whole purpose of limited liability. And it's very important. Now, most people have had sole proprietorships. If you ever had a paper route, if you ever sold lemonade in front of your house, sole proprietorships. Not a big business, not expansive, think maybe carry on for a long period of time, but anything you do by yourself in the pursuit of profit is a sole proprietorship. If you have a friend and you're doing it together, you're a partnership. Most of the partnerships I've had, I didn't have partnership agreements. We just agreed on what we were going to do as far as workload and splitting money and splitting losses and things like that. And we didn't feel the need to go through a partnership agreement. Some partnership agreements are formal and they can be quite lengthy, and a lot of times you need it. Partnerships have something known as joint and several liability. Now, what does that mean? Let's say you come from an extremely wealthy family, hundreds of millions of dollars, and you've inherited the same amount. And you're a lawyer and you're asked to join a law firm, and you accept, and you're made partner. The day you make partner, if that law firm goes out of business, you could be responsible for all the partner's debts. Why? Because it's joint and several. You're responsible individually and collectively. And rather than sue 100 lawyers for the debts of the law firm, if you got 100 million or 200 million, why not just sue you? You can collect everything from one person. That's the downside of partnership. Now, what's the advantage of a partnership? Mostly in how it's taxed. Now, I'm not going to oversell taxation. Books will tell you, corporation, it's easier to raise money. Truth is, it's not. The truth is, it's not easy to raise money no matter what form of ownership you have. The only way it's easy to raise money is if you already have a lot of money. If you need money, it's almost impossible, no matter the form. They say it's easy for corporations because corporations can be listed on stock exchange. But if there's something like 50 million non-corporations that operate as businesses, there's roughly, across all the stock exchanges in the US, roughly 10,000 companies listed. It's just not a big number. But if you want to raise $5 billion, a corporation is the way to do it, and accessing the public markets is how you do it. If you're not going to do that, it's not that easy. LLCs, LLPs, an LLC is a limited liability corporation, and you have the advantages of selecting how you want to be taxed. You could be known as a disregarded entity, which means you're taxed as an individual, and you attach the results of the LLC to your tax return on a Schedule C. You can elect to be taxed as a partnership, in which case the LLC will file a 1065 partnership return. You can elect to be taxed as a corporation, in which case the LLC will file an 1120. Or it could be elect to be taxed as a subchapter S. Subchapter S is a type of corporation that taxes like a partnership. And you would file an 1120S. Corporations, a basic corporation we call a C corporation, or they can elect to be taxed as a subchapter S, basically like a partnership. In the US, we have documents we file at the end of the year. If you're an employee, you get a W-2. If you're a contractor, you get a 1099. Unless you're a corporation or a subchapter S corporation or an LLC that's elected to be taxed as a corporation or a subchapter S, in which case you don't need to get a 1099 form. A lot of people don't like things reported on 1099s, so they'll opt for an LLC and choose subchapter S to avoid that. Any questions so far? Business activities. We group the activities into three broad categories: financing, investing, and operating. Differentiating the three isn't that important until it comes time to do the statement of cash flows. And that's going to be later in the semester. We just mention it now so that you've heard it before. Procedurally in accounting, we're going to start out with transactions. You don't have to write this down yet. We'll get back to it. We start out with transactions that get journalized or recorded. Then it gets posted. Then it gets balanced. Then it gets summarized, and then it makes its way onto financial statements. So financial statements are the last step of the process, and that's what we make available to the public. But we're going to start with financial statements. Even though it's the last thing, we're going to start with the end product, and then we're going to go back to the beginning. We start with the balance sheet. The balance sheet is prepared at the end of business on a specific day. December 31st, for instance. We can say the balance sheet is December 31st, 2014. We can say it is as of December 31st, 2014. We can say it's as on 12/31/14. Any date that refers to a range or a period is incorrect. The balance sheet only refers to a close of business on a particular day. Pick a corporation. IBM, good choice. If we're looking at the balance sheet for IBM, and we look at any of their accounts, and we want to know how we got to that account balance, what do we need to look at? Well, the answer is we need to go back to the day the business was founded and look at every transaction that ever went through that account. The balance on the balance sheet is cumulative from the beginning of time for that corporation. The next statement is the income statement. The income statement is for a period of time, a year, a quarter, 6 months, 9 months, 2 years. So we could say for the year ended 12/31/14. When we specify the period, you have to provide enough information so the user knows when the period began and when the period ended. If I said for the year ended 12/31/14, when does that period begin?
1/1/14.
The 15.
The beginning.
The
No,
beginning of 15.
Does it depend on like fiscal year or calendar year?
it doesn't.
Do we always assume calendar year?
No, you can't assume anything. It has to stay. So when it says for the year ended 12/31/14, what day did it begin? Technically, no. 1/1/14. It begins 1/1/14. So if you want to think of a fiscal year, which is different than a calendar year, we could say for the 6 months ended 9/30/14. Do you know when this period began?
From the beginning. 1-1.
Nope.
No.
1/1,
March 1st.
March 30th? No, March has 31 days to begin.
March 1st.
Still not 31. 3/1. Well, there's only one way to check. March, April, May, June, July, August, September. No, that's 7, right?
So, April 1st.
April 1st.
Yeah.
April, May, June, July, August, September. April 1st. When it comes to calendar year isn't so bad, but anything other than a calendar year, I recommend using your fingers to be sure. It's the easiest way. When will this fiscal year end?
March 31st, 16.
March 31st, 15. Yes. If it begins April 1st, it ends the next March 31st. The balance sheet is always going to be for the last day covered by the income statement. Does anybody know what we put on the balance sheet?
I said something. Cash.
Cash, okay? Those are accounts. Cash does go on the balance sheet, but we'll start with the broader groupings.
Assets.
Liabilities on assets.
Yep. Assets. Anybody give me a definition of what an asset is?
Anything that can be sold.
Anything that could be sold. Can you sell cash?
No.
I mean, you could. Is there any reason to sell cash? It's already cash. No.
Anything like you own, like
That's good. Stop right there.
yeah, doesn't like
Stuff you own. Right?
right.
Pretty much covers it. You know, you're not accountants, so why get too fancy? It's the stuff you own. Liabilities. What are liabilities? Your debts. That's some of it. If assets are stuff you own, liabilities would be
You own.
stuff you owe. Yeah. And the difference between the two is owner's equity. What goes on the income statement?
Revenue and expenses.
I know you wanted to say something, but it's a little low. Let me see if I can adjust the volume.
Revenue and expenses.
Revenue and expenses, thanks. Yeah, you probably just have to get closer to the microphone, Brett.
Got it. Okay, very good. All right, I figured this out now.
revenue and expenses. And when we subtract expenses from revenue, what do we get?
Net income.
Net income. So balance sheet is on a specific day, income statement for a specific period. Balance sheet has assets, liabilities, equity. Income statement has revenue and expenses. How many people have a job?
I do.
How many people have a bank account?
Everyone does.
So on your job, do you get pay stubs?
Of course.
And every period you get added to your year-to-date earnings, whatever you had last time, plus what you made this time. So end of year, last pay stub in December is the biggest number you've seen all year, year-to-date. What happens to that year-to-date number in January?
It goes back to 0.
It resets to 0. Do you lose all the money you've made?
No.
No, it's just accumulating it for a period of time. That's the income statement. Now think of your checking account or your savings account. You end the year December 31st with the balance in it. Does that reset to 0, like your year-to-date earnings? Well, for some of us it does, depending how much we spend in December. But conceptually, it's not because anything the bank does. So whatever your balance is on December 31st, it carries over to the new year, and you either subtract or add depending on whether you're putting in or taking out. It's cumulative. And if you think of your balance that's in your particular bank today, the only way to recreate that number is to go back since you opened the bank account and add every deposit, subtract every check or debit or credit to get that. That's the balance sheet. Never resets to 0. It's just a cumulative running total. Now, what are some examples of assets? Now, these are the building blocks. Almost every single account we'll talk about is either an asset, a liability, an equity, a revenue, or an expense. Now, in some cases, we're going to have a lot of terms we could use interchangeably. Revenue, income, gains, expenses, losses. In some cases, we could swap them in and out. I'm not going to be that particular. Some people call some revenues sales revenue. Some might call it sales income. On the expense side, someone may say payroll expense. Someone may say wage expense. Some say salary expense. To me, they're all interchangeable. So what are some examples of accounts that are assets? Someone said cash before. So what's cash? What does cash mean?
Money, capital.
Money. Okay, so if I said to anybody here, how much cash do you have? What would you tell me? 0. How many people would take out their wallet and count it?
All of them can look at their wallet to see how much.
Right. But we're talking about a business. Very little of the business's cash is kept in bills and coins. Mostly when we say cash at a business level, we're referring to deposits at financial institutions. So when we say cash, it's not only the bills you have with you, it's also your balances in checking accounts, savings accounts, money markets. Sometimes we even include T-bills, what we call cash equivalents. In a business sense, it's deposits, not actual currency. So what else? What else would be an asset?
Safe, the real estate or
Real estate, okay? So property, land, buildings, equipment, vehicles, machinery, furniture, fixtures, things like that. Yeah. What else?
Equipment.
Accounts receivable. I'm very big on abbreviating. So A/R means accounts receivable. Now that's a good one. Whenever you see receivable, note receivable, accounts receivable, loan receivable, you know it's an asset. Someone else had something?
I said equipment.
Equipment, yeah. Equipment, we could say, goes with property, plant, equipment, or fixed assets. There's also a group called intangibles, intangible assets. Copyrights, patents, trademarks, trade names. We'll talk more about those later during the trimester. How about examples of liabilities?
Loan payable.
Accounts payable. Pretty much anything with a payable in it is going to be a liability. Accounts payable, salaries payable, notes payable, income taxes payable, rent payable, interest payable, the whole list of payables. Owner's equity depends on the type of organization we've elected. Since mostly we'll be talking about corporations, we're generally going to be talking about common stock, APIC, which stands for additional paid-in capital. And retained earnings. On the income statement, what are some examples of the types of revenue you can have?
Investment revenue.
Say that again.
Investment revenue.
Investment revenue. We might call that dividends. Dividends, interest, gain on sale of assets. What else might we have?
Sales.
Sales. Sales is going to be a big one. A lot of times for most companies, dividends, interest, and gain on sale are incidental to the operations. Companies will have them, but that's not why they're organized and that's not why they're operating. McDonald's is in the business of operating franchises and selling food. Olive Garden is in the business of selling food and making you feel like family. Microsoft sells software. IBM sells computers, hardware, software, some software, and consulting services. They'll all have interest dividends, but that's going to be incidental. It's the sales that makes them what they are. If you're a real estate company, your income is rental revenue, what you get for renting your properties. Whenever you see something followed by revenue, sales revenue, interest revenue, whatever, chances are it goes on the income statement under revenue. There's only one time you would be wrong where you see revenue and say it goes on the income statement. And that's an account called unearned revenue. Unearned revenue has revenue in it, but it's not a revenue account that goes on the income statement. It's a liability. Other than that, every other revenue is the income statement. What are some examples of expenses?
Salary. Wages.
Salaries. Now, whenever we talk about account names, sometimes the name is used in two places. We can have salary expense, and we can have salaries payable. One's an expense, one's a liability. So we just can't say salaries. We always have to specify which salaries we mean. We could have interest expense, we can have interest revenue. So we just can't say interest. We need to specify whether it's the revenue account or the expense account. Might also be payable. It might also be receivable. So just interest is ambiguous as an account name. So we have expenses, we have salaries, what else do we have? Think of your own personal finances. What are you paying out for?
I mean, everything, right? I mean, you could say the electric bill is an expense.
Utility expense.
Utilities,
You can
say,
split it down. Rent, electricity, gas,
All the
water,
motors.
sewer. Insurance.
I was gonna say cost of goods sold.
Cost of goods sold. Okay, very specific. And what does cost of goods sold mean?
The cost of the item you're selling.
Yeah, but thank you
What
for
you're getting
switching
for
item for
revenue.
goods instead of
That-
saying the definition is the cost of the goods you just sold. But that's really what it is. You sold something that you got revenue for. Cost of goods sold is what that item cost you. So you have rent, utilities, repair and maintenance, salaries, payroll taxes. The list is long. I won't bore you with the hierarchy of how accounting is built, but there are a couple of important concepts. One of them is the matching principle. And that says we match expenses to the revenues they create. Sometimes we have an expense, and the question is, which income statement does it go into? This year's or next year's? If we pay for an advertising campaign that's not going to run until next year, that's not an expense this year because it's not creating revenues this year. It's going to create revenues next year, so that expense will be held off the income statement until next year. We match the expense to the revenues they create. It helps us figure out what period to put it in. Not so important for the balance sheet because that's cumulative. Everything is on there and stays on there. The income statement, we want to get the right numbers in the right period. Sometimes, did anybody ever get a check from somebody at year end you didn't deposit till the next year? So some businesses that are on the cash basis, they are taxed on the income they received when they received it. So the last 2 weeks of December, they make believe they don't get mail. Anything that comes in goes in a drawer. So that's not part of their revenue for that year. Then January 2nd, miraculously, they have all these checks to deposit. That's revenue for that year, if they're on a calendar year. That's the cash basis. In accounting, it's not acceptable. Accounting uses the accrual basis. The accrual basis has nothing to do with cash. That's why we have accounts receivable. Accounts receivable is money owed to us for work that we've performed or goods that we've sold that we haven't received yet. So that's revenue. We're allowed to call that revenue without having been paid yet. The receivable represents the debt to us. And at some point, we're going to collect that receivable, but we've already recorded the revenue, so we're going to reduce the receivable and record the cash. If we were on the cash basis, we wouldn't have revenue when we've delivered the goods or services. We would have to wait till we got paid. For some things, it doesn't work so well. If you're building a battleship and it takes 5 years to construct, theoretically, on a cash basis, you wouldn't have revenue until you've been paid. On the accrual basis, you're allowed to accrete revenue as you go along and earn pieces of it along the way. As accountants, sometimes we're paid in advance for work we have yet to perform. That's not revenue on the accrual basis. We may have been paid, but that's not earned revenue. That's a liability. Until we provide the service or product, It's not going to be revenue. Once we provide the service or product, it is, irrespective of whether we've gotten paid. Any questions about this? So keep in mind, income statement, revenue, expenses, the difference is net income. The balance sheet has assets, liabilities, and equity. Equity has common stock, additional paid-in capital, which is considered share capital, and then retained earnings. Statement of retained earnings, the third statement we're going to talk about. The fourth statement is the statement of cash flows that we're not going to talk about. We're going to hold that for later in the trimester. Statement of retained earnings is a very small statement. There's really only 4 lines on it. It's prepared for a period of time, just like the income statement. Whatever the period is on the income statement is going to be the period on the statement of retained earnings. It starts with the beginning balance. That's the balance at the beginning of the period. Plus net income. Minus dividends equals ending balance. And that ending balance is the retained earnings number that we saw on the balance sheet. Now, what I'm going to show you seems ridiculously simple and unnecessary, but I'm going to do it anyway because it comes up a lot and it's good to remember. Beginning balance plus things that increase that account minus things that decrease the account will give you your ending balance. What those things are depends on the account. We're talking about retained earnings. Things that increase the account are net income and the components thereof. Things that decrease the account are dividends. And we can provide this type of analysis for any of the accounts. So it's always good to keep in mind this basic formula. Now, being a good accountant really is about understanding the way things work, the way they interrelate. I remember when I was in college taking accounting, I was learning the stuff, looking at it, right, rewriting my notes, reading the chapters, doing the problems. And I was meeting with CPA firms, and I was speaking to a partner at a small firm. And he said, right now, you're working to understand. one day a light bulb is going to go off. And when it does, everything will make sense. It'll no longer be work to understand it. And I forgot where I was, but I do remember the feeling when the light bulb went off. All of a sudden, this all made sense. Now, I know you're probably thinking, thank God, I'm not going to be in this long enough to realize that. But if you're going to pursue this as a career, then when that light bulb goes off, it's definitely worth it. One of the other seminal events in my life, I knew I wanted to be an accountant when I was in junior high school. So it wasn't odd for me to major right out of high school going into college. I didn't need to spend 2 years to find my major. So as a freshman, I really wasn't taking any upper level accounting yet. But I did go to all the accounting club type things. And I remember the chairman of the department saying, and this is applicable to whatever your major is. He said, you're here because you're accounting majors. When you're in class, don't learn it to get an A in the class. Learn it because it's something you're going to use for the rest of your life. And if you want to be a guy who just has to study and think about everything, you could be an okay accountant. But if you want to be the expert accountant that people look to, then now's the time to make sure you learn things properly. And it made a lot of sense to me. I'm sure a lot of people there said, oh my God, the rest of my life, I'm not sure this is what I want to do. But for me, it made sense. And I didn't realize it at the time, but one of the great benefits of accounting as a major is you can do anything with it. You can perform almost any function in every company that's not specialized. Now, I remember going one time stopping at my parents for dinner, and my dad said, I found a job in the paper for you. I think you'd be great. It happened to be chief of pediatrics at Long Island Jewish Hospital. And believe it or not, accounting didn't train me to be a pediatrician. So there are some things maybe we can't do, but there are a lot of things we can. If you look at the background of a lot of people, you'd be surprised to see how many are CPAs. So we have the balance sheet, the income statement, and the statement of retained earnings. We're going to go ahead and prepare them. Which one do you do first?
Balance sheet. The balance sheet.
Balance sheet. Okay, why the balance sheet?
It's the page.
I tell you, I always do the balance sheet first. I got mad skills. So for me, it doesn't matter. But if you're teaching people and saying there's a logical order to things, balance sheet is the one you do last. The one you do first is the income statement. Revenues, expenses, net income. What statement do you do second? We're down to 2, so you got 50-50 chance. Balance sheet, still not ready for the balance sheet. No. It's the statement of retained earnings. Which one do we do third?
The balance.
Now it's time for the balance sheet. So why this order? If we wanted to do it sequentially, we need net income to complete the statement of retained earnings. And we need ending retained earnings to complete the balance sheet. So we start with 1, we take that number, we move it to the next statement, and we could do it in order. Now, why did I say I could do the balance sheet first? Because my balance sheet's balanced. So if my assets are 100,000, and my liabilities are 80,000. And my common stock is 5,000. How much is my retained earnings?
15.
15,000. Because the liabilities plus the equity has to equal the assets. So I can work backwards. Everybody can work backwards, but if you have more confidence in your numbers, you can back into it. So you just got to make sure as you do each statement that those numbers are right. Pick a number from 1 to 9. Don't tell me it. You can write it down. Multiply whatever number you pick by 9. If it's 2 digits, add the 2 digits together. Subtract 5. Now you have a number. With that number, find the letter. So if it's a 6, you use F. If it's a 3, use C, so on. You have a letter. Pick a country that begins with that letter. Using the second letter of your country, pick an animal that begins with that letter. And pick a color associated with the animal. Now I'll give you a gray elephant from Denmark a name.
I haven't found the country yet.
You still working on the country? I would go Denmark, elephant, and gray. CSG. Once you enter the accounting layer, we go in your mind.
Wow. Do you like pull that out at parties?
Oh, yeah, that's why I don't get invited anywhere, because I did it once.
Wow.
Yeah, it's not bad. And here's another one for math people. Add up all the numbers from 1 to 100, 1 plus 2 plus 3 plus 4, and do it in less than 5 seconds.
199.
This one actually comes in handy. What's 1 plus 100? What's 2 plus 99? What's 3 plus 98? How many pairs like that are there? No. 50.
99.
50 pairs. So that sum is 5,050. It gets a little tricky if it's not even numbers, if it's odd numbers. Not too tricky. Leave off the last number, make the pairs, and then add the last number to it. And it's just not for showing off. There's actually going to be some examples we're going to do when we get to depreciation methods. One of them is called sum of the year's digits, where we add, if it's an 8-year life, 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8. Or if it's a 30-year life, we add from 1 to 30. So this type of math trick actually will come in handy. Okay, so do we have any questions so far? Let's get to some of the questions in the book. How many people read the chapter? That's pretty good.
I just ordered my book.
You're getting the third or fourth edition? Third. Now, the third edition is the same material. The only difference is they changed some of the questions. So your questions may be a little different than ours, but the material should be the same. And mostly, I'm going to reiterate the questions. And I didn't really expect anybody to read the chapter before class. Generally, everybody learns differently, and the key is to understand how you learn best. I remember my first class in college was a psychology class, and one of the classes where I didn't fall asleep, he taught me something that made a lot of sense. He said we learn best by attaching new information to old information. So he said, if I give you a chapter to read for homework, don't try to read the chapter. Because by the third page, you're turning the pages and you forgot that you even looked at it. It says, go through the chapter and just look at the pictures. Then later on that day, the next day, go back and look at the headlines or the blocks of information that seem appealing. So then go back and try to read the chapter. It says by the third time, after not trying to read it, but just looking at the things you're interested in looking at, it'll attach. And when you come to class, whatever I say will be attached to your reading. And I tell my students that all the time. You would think that at least one of them would try it. Most of them don't. They come to class, they haven't read the chapter, so whatever I say is the first time they're hearing it. It's very hard to process. If they had read the chapter and had some idea, not that I want them to learn from the book. If you learn from the book, you don't need me. You could stay home. Most people can benefit by having someone explain it to them in person, but only if they've made a little effort to understand what's coming up. It works better. I'm not going to make you. I'm not going to test you. I'm not going to quiz you to see if you read the chapter. If it works better for you, that's great, because it makes learning a lot easier. My thing was always coming to class, no matter, sometimes I was sick as a dog. I'd come in reeking of Vicks Vapor Rub. No one would sit next to me, but I had to be in class. I always did the work in advance, and I recopied my notes every day. First thing I got back to my room, I recopied the notes, and that reinforced it. Never had to study for a test. Made a big difference. Okay, I'm going to put some accounts on the board with balances. If you have the fourth edition, it's exercise 6. So the accounts and the balances we have are cash, $5,400, salary expense, $2,200, accounts payable, $3,400, retained earnings, $3,900, utility expense, $1,200, supplies, $13,800, service revenue, $9,300, common stock, $6,000. And we need to prepare an income statement. Now, the first 3 lines of every financial statement begin with the name of the company. In this case, it's Cowboy Law Firm. The name of the statement, in this case, it's the income statement, and the period of time. All it tells us is account balances at the end of December. So we don't know enough to put down the period correctly. So in that case, we will say, for the period ended 12/31. Do we know when the period began? We don't. So ordinarily, this would be an incorrect phrasing of the period. But this is the best we could do with the information we have. If we had information where we could put in for the month ended 12/31, or for the year ended, or for the quarter, this would be wrong. But in this case, this is the best we can do. Every statement begins with those 3. Name of the company, name of the statement, date or period of time. What comes first on the income statement? That's the balance sheet. Revenue. And what revenue do we have?
Revenue earning.
No and no.
On these,
Was that?
on these.
Yeah, this is a list of a whole bunch of things. Not all of these things go on the income statement. Usually we get a list. That list is called the trial balance. It's all our accounts with all the balances. And we have to pull the right ones to make our statements. So if we're going to start with revenue, which one of these are revenues?
Service revenue?
Service revenue. Are any other of these revenues? No, just service. So then we have expenses. Which of these are expenses?
Salary.
Salaries. Now, you remember how I said that salary can be salary expense or salary payable? It's ambiguous without the second word. Well, in this case, we don't have to put in expense because we're listing it under expenses. To make this list, we needed the word expense in it. But as we make the statement, we can drop expense since we're listing it under expenses. So salaries were $2,200. What else? Utilities? 1,200. Anything else? No, that would be it. Supplies is ambiguous whether you call it an asset or an expense. Since they didn't use the word expense, they're going to call it an asset. Some companies keep their supplies and only record what's used. In real life, you don't do that. You know, if you have 4 staplers and 8 pens, you don't worry about calling it an asset as you use it. You just make it an expense when you buy it. If you have expensive supplies, I remember I audited a company that filmed commercials for TV. And so it was a recording studio essentially, and they had never been audited before. So they were told that the auditor's coming in, and they had this rack that ran across one wall with these little baskets on it. And somebody said, you know, in preparation, You got these little baskets, anything of value in it. They said, well, yeah, this one has 3 little CCDs in it. And they said, well, what do they cost? They said about $250,000 a piece. They said, okay, here's what you need to do. You need to label each of the baskets and say how many of each things are in there. And if, going through, you use it, if you said 3 and you use one, cross it off and put a 2. This way you could do your business. But apparently you have a lot of value here we need to count. So I came in and I saw her and I started going through, and they were diligent. They were told to label and count everything that's in these bins. So all these parts are there, and I'm counting the parts. Then towards the end of the wall, I get to small paper clips, 1,342 crossed out, 1,341 crossed out, 1,340. Then the big paper clips, the jumbo paper clips, the binder clips. The best was when I got to the McDonald's salt bin, the McDonald's sugar bin, and the McDonald's stirrers. Believe it or not, we didn't have to count that. We were okay not valuing the stuff you steal from McDonald's to keep on hand for your coffee supplies. The CCD stuff was expensive. The paper clips we could have done without. But they were told count the bins, they counted the bins. So in this case, we're going to leave it as an asset. So we have expenses, salaries, utilities, total expenses, and then net income. Now, conventionally, how statements are prepared, I won't hold you to. We have a heading, and then we indent. We have service. Some people would put a subtotal, but where there's only one number, I don't like putting subtotals. I think it kind of looks silly to put a line and then get 9,300. We have 2 expenses. They total 3,400. The top number gets a $sign. The last number gets a $sign, not in between. Single lines and double lines do serve a purpose. A single line lets you know there's a subtraction or an addition. So this line tells us that number is the sum of these 2. Then this line tells us that's a result of an addition or a subtraction. In this case, the revenue minus the total expenses. The double underline lets us know we've ended the statement, or we've ended the section of the statement. And conventionally, whenever we have something that has 2 words to it, like net income, only the first word gets the capital. It would be lowercase I. If we actually wrote salary expense, the S would be capitalized, the E would be lowercase. None of this really matters for you, however you do it. As long as I understand what you're doing, that's what counts. So whether you had the capitals right, that doesn't really matter. Neatness sometimes does, especially with partial credit. If something's right, that's not too hard, but if it's wrong, trying to figure out how much you got right is easier the neater it is, and I can usually tell. Indenting, some people could indent or offset, depending on how many numbers and how many sets. Something simple like this, just a small indent under revenue and under expenses would be enough. The balance sheet. Let's see, we've used salary expense. We've used utilities. And we use revenue. So if we wanted to take the rest and make a balance sheet, this one we know it's on 12/31. We don't know what year, but we know it's the last day of December. One more thing. What order do we put the revenues and expenses in? We only have one revenue. So in this case, what order should we put the expenses in? In our case, whatever came first in the list we were using is what we put. Is that okay to do? Alphabetized, that's one possibility. What's the other possibility?
What's the greatest?
Biggest number first. I'm all for randomizing. Whatever comes first in the list, I'm all for alphabetizing or biggest number. Conventionally, people say biggest number. Most important, looks better. Me, it doesn't matter because there's no information presented. Any user could look at it and know what the biggest number is. You don't have to have inside knowledge for that. Alphabetizing, the same thing. So for me, there's no information presented by the order. So I'd use that as optional. I don't really care what order you put it in. What assets do we have?
Cash.
Cash. Any others?
Revenue?
No, revenue, we crossed off because we've already used it. Revenue goes on the income statement.
Supplies.
Supplies. So total assets are 19.2. Should we pay any attention to the order we put the assets in? 50-50 chance, yes or no? The answer is yes. Assets and liabilities are placed in what's known as liquidity order. Liquidity means nearness to cash. So in a basic course, we put cash first because it's already cash. You can't get more cash than cash. And then we order the rest and how soon we expect it to be converted into cash. Sometimes we'll have marketable securities, investments next. Then accounts receivable. Then we'll have inventory, prepaid expenses. Sometimes the order may change a little bit. So information is conveyed by the order of the assets that the user wouldn't have if we did it alphabetically or by biggest number. So it is important to think about the order of the assets. What liabilities do we have?
Accounts payable.
Accounts payable. Anything else? That would be it.
What? What? What?
Then we have the equity section. What was that?
I think he's talking to his mom.
Oh, is that what it is? You're looking at the hand, so it kind of does look like that. Equity we can call shareholders' equity, stockholders' equity, all synonymous. And under the equity, we have common stock, and retained earnings.
Grandma, would you mind going, please?
Listen, is it possible if we have 3-0 cross line, make it as a cross line
You mean like,
Are you serious? I'm in the middle.
yeah, you mean, you can do almost anything as long as I understand what it is you're doing. I'll sometimes do that.
That's
Sometimes it gets messy if we do millions.
Oh, yeah. Yeah, I'm just saying if it's just,
Yeah, I would have no problem. The main thing is I understand what you're doing, and if you want a shorthand for a line for the last 3 zeros, generally that would be okay. So I'm running out of room, but we would have a subtotal for the equity section, and then we would have liabilities plus equity. And how much are liabilities plus equity going to be? Liabilities plus equity will equal 19.2, right? The assets. So if accounts payable is 3,400, how much is the equity section? The equity section is 19.2 minus the 3,400, right? Is that 15.8? And if the equity section is 15.8 and common stock is 6, how much is retained earnings going to be?
9,000.
98, right? So it doesn't look much like a real statement, but just imagine this came underneath and it was a little neater.
I'm sorry.
But we
how
got
did you get the
retained
98?
earnings is 9,800, but here it says 3,900. So how do we get from 3,900 to 9,800?
We had the net income to the beginning balance of the retained earnings.
Exactly right. So we do the statement of retained earnings. Cowboy Law Firm, statement of retained earnings for the period ended 12/31. There's that beginning retained earnings. It was from that list we had. Now we're going to add net income from the income statement. Minus dividends equals ending retained earnings. So we didn't do this statement in the order we suggested was best, but we still were able to come up with what the balance should be to make the balance sheet work. Now when we do the statement, we just want to verify that indeed that's the number we got. So when we go from one number on the statement and agree it to the same number on a different statement, it's called articulation. Any questions about this?
How did you get the $9,800 in the retained earnings under the balance sheet?
When I did it over here,
Yes.
I knew my total assets were 19,200. And I knew my total liabilities were 3,400. So I knew that meant my equity section had a total 15.8 because assets equal liabilities plus equity. So my assets were going to equal my liabilities plus equity. My assets were 19.2 and my liabilities were 34. It made my equity 15.8. If my equity is 15.8, which is the sum of common stock and retained earnings, my common stock was 6,000. So 15,800 minus 6,000 equals 9,800.
Thank you.
Sure. If we had done the statement of retained earnings first, I wouldn't have had to guess or back into the number. I just would have been able to take the 9,800 off, then just to make sure my liabilities and equity equaled my assets. Any questions about this? Transactions are things that happen that require recording in the financial records. Not everything that happens during the business day requires recording. Some things do. We record things by making an entry. An entry involves a debit and a credit. Now, a lot of this is next chapter. I'm just kind of getting you ready for this and trying to make it a little easier. Debits and credits equal each other. Each entry has at least one debit and one credit. Could have more than one, but the total of the debits and the total of the credits have to equal. Assets equal liabilities plus equity. It's the accounting equation. Really, a lot of people teach it in some detail. I've never seen the great value in it. The only reason I'm putting it up is to expand it and illustrate one point. What is equity equal to? Think of the equity section. What are the components in the equity section?
Asset minus liability.
Common stock and retained earnings. So assets equal liabilities plus common stock and retained earnings. So this is just a math equation, and these are just variables. What is retained earnings equal to? Think of the statement of retained earnings. It's equal to beginning retained earnings plus net income minus dividends. What is net income equal to? Revenues minus expenses. So plus revenues minus expenses minus dividends. We've just expanded by inserting the components that make up those items. So whenever we see a math equation with pluses and minuses on one side, what do we do with the minuses? We move them over. So assets plus expenses plus dividends equals liabilities plus common stock plus beginning retained earnings plus revenues. Let's draw a line through the equal, and we'll call this the left side and the right side. Anybody know what that T-shaped thing is called? called a T account. Anybody know why it's called a T account? Looks like a T. If ever you're trying to guess at a name, pick the most obvious blasé one, because accountants with naming have never been creative through the ages. That is called a T account. And I like to think in terms of T accounts. Over the last 20 years, some people teach accounting without ever referring to debits, credits, or T accounts. They refer to pluses and minuses and use Excel. And that could work. But I've always liked to think in terms of T accounts. That's what I had when I started working in accounting. And a lot of times today, when I'm thinking about complex transactions and what happened, I'll make T accounts to help me think my way through. Across the top of the account goes the name. So if we're talking about cash, we would have a T account that would be called cash. The left side is debits. The right side is credits, no matter what account. Left side debits, right side credits. What changes is the effect debits and credits have on the account. When we're on the left side of the equal sign, debits increase and credits decrease. When we cross over the equal sign, what do you think debits and credits do? The opposite. So assets, expenses, dividends, debits increase, credits decrease. Liabilities, common stock, revenues, debits decrease, credits increase. Now we've seen some of the statements, we've made some basic ones. The next chapter is going to be getting the transactions in a form recorded, ready so we can make the statements. That's the process of accounting. Identifying transactions, journalizing, recording, posting to the T account, balancing the T account, taking the balance from the T account and making a trial balance, adjusting entries, taking a new trial balance, and then from the trial balance, preparing the statements. Today, realistically, everybody uses computerized software of some sort. Very few people do accounting by hand. When I started in accounting, there wasn't computers. There were mainframes and that was it. There was one, it wasn't a PC, it was a local computer that had a language called APL. Did anybody ever hear of APL? You know what it stands for? A programming language. And that's what you could use these terminals for. You didn't have to do the punch cards like on the mainframe, but you couldn't do much with it. You could do simple mathematical expressions. Now, everything is computerized. Accounting software at the low end, for any size business, you have anybody ever hear of QuickBooks? Fabulous software. I work for a private foundation. We have $750 million in assets. We use QuickBooks. Fantastic for our purposes. And then you could go up to some bigger systems, legacy systems, million-dollar systems, depending on how big and complicated, how many different sites are reporting to one particular summarizing location. You can get as complicated as you want. We're going to be learning how to do it by hand. One of the advantages is computers do nothing more than what we're doing, only faster and more accurately. But it's only as good as the information put in. Eventually, someone has to put information into the system, whether it's manual or computerized. And if something's not right, it helps to know how the system works to be able to find it and fix it. So that's what we'll be doing in the next class. Any questions about what we did tonight? How many people now want to become accountants? Nobody, huh? I'll tell you, sometimes you could do some interesting things. One of the things we have to do when we do audits is count inventory. Sometimes it's not exciting. I had a battery importer, and so they had these crates of batteries that I had to count. I didn't have to count everyone. I had to open a sample and make sure they had batteries and make sure the count inside is what the crate said. And then I could just look at the crates and use that. One time we did a silk import. And silk is very interesting. I didn't realize there were so many types of silks. It was a huge warehouse. It was like the size of a small Home Depot. And all they had were these huge rolls. Each roll was about, I'd say it's the length of this table and about that big around. Some of the rolls were whole. They hadn't been opened yet. So they're marked how many yards were on it. But most of them had been opened. And you couldn't tell based upon the width because depending on the silk, it had more yards depending on how thick it was. So we had to count the inventory. We didn't know what we were going to do. So the foreman said, I've been here like 25 years. I can tell you how many yards are on that roll by looking at it. I said, how about if I walk up and down the aisle and I'll put a Post-it on each one saying how many yards are left. Now who would trust that? We had thousands of these rolls. So we decided, let's do that. Then we'll take 30 or 40 and put them on the machine that unrolls them. And as it unrolls it, it rolls it onto a new roll and it counts the yards. And we'll test his estimate. Over all the ones we tested, what do you think his percentage error was?
1%.
It was actually more. It was like 4%. But the rollers had a 5% error. Because sometimes it gets stretched as it goes, sometimes it's uneven, sometimes it's looser. So he was better than the rollers were. So we actually could use that. That's some of the fun of what you get to do in accounting. That's interesting. Of course, not everything is fun. One time I got a lawyer hired me, said, our client is owed money. The company says they have no assets, they're going out of business. I want you to go and see if you can find hidden money they had. That was a lot of fun. That's the kind of thing you could enjoy. It's not usual stuff. Some people think all accountants do is put debits and credits. And back in the day, we had this green ledger paper with these little boxes we put numbers in. That's how you started years ago, but it's grown into a lot different. There's a firm on Long Island called Grassi & Company. I know some people that work there. But their tagline on the radio is accountants and success consultants. So they've really expanded the reach of what accountants can do. They're now success consultants. Others are accountants, auditors, and consultants, financial advisors, trusted friends. We've really gone beyond. So it's an interesting profession, but I'm not going to try to sell you on it. And in fact, the more we go into the semester and you see what we do, probably if you're excited now, you may get a little less excited. But there is an advantage to knowing how everything works. So next time, we'll pick up with chapter 2, and we'll actually go through the assigned problems. So try the ones that we've assigned in the course outline. Now, generally, I'm not really interested in having you slave over it so you come in with the correct solution. That's not the goal of assigning the exercise. It's so you take a look at it and think of what's involved and try it. If you can't give up, go to the next one. And if you wind up solving none of them, that's fine. But if you come in and just watch me put it on the board, you're going to learn nothing unless you tried it first. Usually once a semester for my undergraduates, one test is made up of photocopied homework assignments that I did in class. Usually a test is 3 chapters for them. So I picked one question they were assigned for homework that I put on the board to solve. And I don't change a thing. The only time I've ever changed anything is when I took out a requirement to make it shorter. First time I did this, their average grade was 52. Their average grade has never been out of the 80s, and most of the time it's in the 70s. Why? Because if I go back to something I put on the board at the beginning of class and ask you to replicate it, you probably can. Like if I brought a piano in, and I did half a minute of keys and asked you to replicate it, can you? Not unless you're a really good piano player. So take the piano away and put a marker in my hand. Not easy to replicate what you've seen. Anybody ever play Trivial Pursuit? Used to be a popular board game. And a lot of times you go through, you play it a lot, you hear the same questions again. A lot of times people still get the same answer wrong. They had the question, and it may have been a while ago, but you think, I already heard that question, and they still can't get it right. But seeing it done isn't the same as doing it yourself. So it's worth giving it a shot, even if you don't complete it. So have a happy Thanksgiving, good vacation, safe travels, and I'll see you next week.
Thank you, Professor.